Okay, so we're going to do something a little bit different this time. Normally, I shit on financial influencers. I'm a financial professional. I'm an investment advisor. But this time, I got a good one for you. And if you're really serious about trading and learning for this one, you'll stay through to the end. It's a little way longer than it normally is. And the reason why it's long is to understand options and options contracts. It takes a while. It becomes so easy at some point that you'll if you hear the same thing twice, when after it fully clicks, you'll start falling asleep because it's you got it. But at the beginning, it's just a little complicated, and you want to pay close attention. The reason why you want to pay close attention is either it can make you a lot of money or you can lose your shirt on it, right? And these things were originally designed for safety, right? And now, people can use them as casinos. So there's a safe way to do it, and there is a very risky way to do it. Not saying that one is better for one person than it is for another. You got to check your own suitability, but there's a risk involved with each, and we're going to go over that. So my man's videos are usually about 10 minutes long. If you look at this one, it's about it's close to an hour, right? And this is Clear Value Tax. I like this guy. I believe he's a CPA, but he knows his stuff. He's pretty good. Some of these other guys, it's like if we go through all these, they're so for example, 12 minutes. This guy right here is 9 minutes. These are way too short, way too short to understand options contracts in that period of time, right? Okay, here's one. This guy is 3 hours long, right? 3 hours long. I don't think that's enough, right? If you want to understand options in their entirety, if you want to understand spreads and straddles and iron condors and all that stuff, 3 hours is not enough. But Mr. Clear Value Tax here, you'll understand the basics, and that's enough. If you want to go crazy later on, you can, but this is going to be a good video. So I hope you watch to the end, because if you do, you're serious about learning about investing and trading.
Digest all of this information. That's going to be normal. So please subscribe, and we're going to start with call options. Okay, so let's break this down to the fundamentals. So what?
Okay, so there's two types of options, right? There's puts and there's calls. When you think of a call option, think of it as, let's say, a down payment on a car. So, for example, other people are interested in the car. You want to buy the car, right? There's going to be a mechanic check later on, right? So the car could be in pristine condition, therefore your deposit was well played, or there could be something wrong with it, right? And you decide not to buy it. So just look at a call option as a deposit on something. If you understand that, we're good to go at this point.
What are options? Options are simply contracts. They're options contracts. So it's essentially a deal between you and another person. So I want to show you this from the perspective of the buyer. So in our example, you will be the buyer of the options contract. And again, this is a call option. Now we'll just pick any stock. And in this example, we'll use Yelp stock. So the price of Yelp is at $35.84. But to keep it simple, let's just round it up and say that Yelp is at $36 a share.
Okay, again, my man is from accounting, so I'm gonna pick the most layman numbers possible, right? Okay. All right, so Yelp is trading at 90, right? My strike price right here is at 100. So once that contract goes up to 100, or if Yelp, I should say, goes up to 100, then it's going to be what's called in the money, right? But remember, I paid $5 for that contract, right? So in order for it to be profitable, I would need it to go to 105 and past 105, right? Then I am making money. Now, the thing about these contracts is one contract equals 100 shares, right? If you understand that, you're good. So just to reiterate one more time, Yelp is at 90. My strike is at 100. In order for it to be profitable, because remember, I paid 5 for the contract, I needed to go to 105, right? Now, let's say it goes up to 110, right? So it went from 90 to 110. How much did I make? How much did I make? Well, I didn't make $5. I didn't make $5. I made $500, right? Reason being is one contract equals 100 shares. If you understand that, we can move on.
Give you the option to buy Yelp at $38 a share in the next 30 days. And for you to have that option, you pay me 80 cents. So is that a good deal or is that a bad deal? Well, honestly, it's hard to say because we don't know if the stock price of Yelp will go up or down in the next 30 days. But let's just say that you buy.
But that is the beautiful thing about contracts, right? Is that you pay less, and if you expect it to go up, you get more. On the flip side, let's say you make, now, I'll illustrate this, right? On the flip side, let's say you have a short position, right? You have a short position. The problem with short positions is that you're using margin. And if you're using margin and you have a short position, and remember GameStop? So you have a short position on your GameStop, and GameStop is going up to infinity, right? You're going to get a margin call. And those things are really, really bad. So, in order to ensure, let's say you shorted 100 shares of GameStop. Buying that call option, you could use as insurance. So, let's say you know Roaring Kitty's about to do something nasty, right? And you already have you're shorting GameStop, right? 100 shares. Buying one call option would be the way to go, just to ensure that you're not going to lose your shirt, right?
Buy that contract for 80 cents. And now you have the option to buy Yelp at $38 within the next 30 days. So here's how you win. The price of Yelp right now is at $36. So let's say that within the next 30 days, the price of Yelp hits 42. Then in this situation, you're going to make good money because here's what's going on. So the options contract that you bought was a call option. So you paid for the option to buy a stock at a certain price within a certain amount of time. Now in our example, Yelp hits $42. So you have the option to buy Yelp at $38. So would you buy Yelp for $38 in this situation? So the answer, well, it should be, of course you would, because you could buy it for $38 and then immediately sell it for the going rates of $42. And then you end up with a gain of $4 a share. So here's what your profit would look like. You buy Yelp.
But remember, you have to add in that price of the contract. And that's if you're buying a contract. You could also write the contracts too, but we'll get into that later.
At $38, you sell it for 42, but you have to remember that you paid 80 cents to have this option. So you net a profit of $3.20. And I want you to know that this is a real life example. You could take a look for yourself. So this is the Robinhood platform. So all platforms will look pretty similar to this. So you see at the bottom right where it says trade Yelp options, which I outlined in red. So you click on that and it takes you to this. So I just want to say, don't be intimidated. I'm going to walk you through this and it's going to be very easy to understand. So these are the options contracts at different price points. If you want the contract to be at 38, then 38 will be your strike price. So as you can see here, you're going to see the options contracts with different strike prices, 35, 36, 37, 38, 39. That's just a limit of my screenshot. So you can go for an options contract with a strike price at $50 or even at 20, but I'm going to explain the difference to you in just a little bit. But for right now, let's just focus on you buying the call option at a $38 strike price and take a look for yourself. That options contract is selling for 80 cents. So was our example of Yelp going to $42 in the next 30 days possible? Well, take a look for yourself. So I've highlighted in red in the top left, Yelp has gone up by almost $7 in the past 30 days. Now let's go back to the topic of you winning and making money. So Yelp is at $36 currently. You bought the call option with a strike price at 38, and that option will cost you 80 cents. So if Yelp goes above $38.80 in the next 30 days, then you're going to be at a profit. So maybe, who knows, Yelp could go up to 40, it can go up to 42, maybe 50, it could go to 100. I mean, that would be unrealistic, but it's not impossible. If Yelp skyrockets, then you're going to make so much money because you're going to have the option to buy it at 38. So if you...
Now remember, again, every one contract is worth 100 shares.
buy the call option, then you want Yelp to go up as much as possible, as fast as possible. Because if you think about it, it's very straightforward. If Yelp goes to $100, you can buy it for 38 and then sell it immediately for 100. So I just want to point out that that's the happy scenario where everything works out and you make a lot of money. But we have to talk about the flip side of the coin. We have to talk about how you can lose money and how you can get absolutely destroyed. So the danger is that you have a limited amount of time.
So here's the issue with that, right? I'm a financial professional. When I discuss options, I can't discuss, I'm regulated. I'm literally regulated by FINRA. I cannot discuss just the positive sides of the trade, right? I have to discuss the negative sides too. So, that being said, you could lose the money you spend on the contract if you were to buy a contract. If you were to sell a contract, especially what's called a naked call, baby, those are the absolute most dangerous things you could do. You can make some good money, but it is risky.
Before your contract expires. And in that time, if the price of the stock doesn't do what you want it to do, in that set amount of time, then you're going to end up with a worthless contract. So I have to show this to you. So here's how that unhappy scenario plays out. Yelp is at $36 right now. You bought the call option to have the option to buy Yelp at $38. In the next 30 days, if Yelp is at $38 or below, then your contract is worthless. So I want to demonstrate the good and bad scenarios for you. There are 4 scenarios. So here's scenario number 1. Yelp is at $36 a share currently. You have the option to buy it at 38 within the next 30 days. And let's just say that the stock price, it goes down to $30. In this scenario, your contract is terrible. It's worthless. Why would you use your contract?
Wait. Okay, he has a 30-day. He has a 30-day. All right. So there's the intrinsic value, and then there's the time value, right? When you buy it, you can buy it. You can purchase it with intrinsic value. But in this scenario, it's at 36. There's no intrinsic value. There's always that slim chance of time value. So instead of executing or excuse me, exercising your contract, it's always good to sell your contract if you have some time value on there.
Contract to buy Yelp at 38 when you could just buy it on the open market for 30. And remember, you paid 80 cents for that contract, so you wasted your money and you lose. So here's scenario number 2. Yelp is at 36. You have the option to buy it at 38 within the next 30 days. And let's just say that the stock price, it goes up to 37. In this situation, it's the same. It's the same thing. Why would you use your contract to buy Yelp at 38 when you can buy it on the open market for 37? So yes, the price of Yelp stock, it did go up. It went up from 36 to 37. However, it didn't go up enough because it's still below the strike price on the contract. So you wasted 80 cents to buy that contract. I mean, the stock went up, but not enough, and you still lose. Moving on to scenario number 3. So Yelp is at 36. You have the option to buy it at $38 within the next 30 days. And let's just say that Yelp goes up to $38.50. So in this scenario,
Okay. In industry terms, that's what's called in the money, right? So you made $50 on the contract. Or actually, I don't know what you said, you paid 80 cents. It's in the money, but you still lost money. Because in this scenario, the contract is worth 80 cents, right? So yeah, you lost out, but your contract's still in the money. But again, if there's still time value on the contract, you might want to, you could sell the contract and you'd probably make money on it. Let's say if that happened within like the first 2 days of purchasing that contract.
you can buy Yelp for $38 and you could sell it for $38.50. So that is a gain of 50 cents. So congratulations.
Wait, whoa, 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 whoa. He better come up with a however, because remember he paid 80 cents for that contract.
However, you still lose
Yeah.
money because you paid 80
Okay.
cents for the contract. So your true cost basis, it's $38.80 and you can sell it for $38.50. So you still lose, but at least it's not a total loss. So here's scenario number 4. So Yelp is at 36. You have the option to buy it at 38 within the next 30 days. Yelp goes above your cost basis of $38.80, and then you're going to be at a profit. And the more it goes up, the more money that you'll make. So basically, in this situation, you want the price to skyrocket. For example, the best news would be Google decides to acquire Yelp for $60 a share, and Yelp stock, it skyrockets in price within your 30 days. Now, here's the thing. I want to tell you this because this is so important. With call options or options contracts in general, you can buy and sell them just like a stock. So in our example, if Yelp goes to $60 a share, you don't literally have to buy Yelp for $38 and then sell it for $60. You can just sell the options contract itself. But if Yelp is at 60 and you want to buy Yelp for
And listen, that's what most people do. That's usually the smarter choice than it would be just to execute the contract. Sometimes I can't think of a scenario where it wouldn't be. If you really want the stock, I guess you could do that, and you have like a day left. It's 3 o'clock on the third Friday of the contract. The contract's about to expire. Then you could execute it just to make sure. But usually you want to sell the contract and just get the money.
for 38 and just hold on to it.
Unless you want to get the stock and you could bake that the cost of the contract into the stock, and that would affect your cost basis, and you don't want to pay any short-term cap gains. That's the scenario that you could use it in.
You can exercise the option and buy it for 38 and just hold on to the stock. And then your options contract, it'll disappear from your account, and then you'll end up with the Yelp stock. Now let's go back to the options screen. So I want to explain this whole option chain to you. That's what they call this. So you can buy call options at different strike prices. So let me tell you what is going on here. Okay, I want to ask you a question. It's pop quiz time. So I'm going to give you two offers. You tell me which one sounds better to you. Yelp is currently at $36. So here's my first offer. In the next 30 days, I'll give you the option to buy Yelp at 38. And my second offer, in the next 30 days, I'll give you the option to buy Yelp at 39. So which one sounds better to you?
Well, obviously 38 is going to be better, right? But it's going to be more expensive as well. So it just really depends on how much movement you have and your budget. And let me show you guys I'll show you a little something too, a little strategy. So we're not there yet, but we're going to get there. This is probably where this video is going to go. So remember, in this scenario, Yelp is at 90, right? Yelp's at 90. The strike price, so in his scenario it's 38. In this scenario it's at 100, just for the easy math. The strike price is at 100. We think it's going to go up to 105 or past 105. At least it's going to go up, or at least we think it's going to go up to 105, right? We think it's probably going to go up to 110. Now, here comes the strategy, right? So, let's say we don't think it's going to get up to 120, right? 120. That's a 2, y'all. So, you know what? I'm going to perfect that. So we don't think it's going to go up to 120. What we can do at this part right here is we can start writing a contract, right? So we'll write a contract at 120. What that will do is say, we're going to write the contract for 2, right? So what that will do, that's an @ symbol, that will reduce this puppy here to 3, right? So we're betting on it moving from here to here. Because once it goes above here, our profit is over. Now we're not going to be on the hook as long as the expiration dates are the same. So remember, he has 30 days in his example. So if I write the contract and the expiration for 120, and that's the same expiration for the contract right here, you're okay. Because even if it goes above 120, you're still covered by your original contract. But that's just a strategy for it to get cheaper. That's called a spread. And this would be called a bull. It would be a bullish spread, right?
Of course, option number 1 sounds more appealing because I would rather have the option to buy Yelp at 38 instead of 39. Therefore, the contract at 38, a $38 strike price, is more appealing. Okay, but here's the thing. These circumstances, they're factored into the price of the options contract. Now, I want you to compare the contract at 38 versus 39. The contract at 38 is selling for 80 cents. The contract at 39 is selling for 55 cents. So if you want to buy a contract with a higher strike price, the contract will be cheaper. That's because it's less probable that Yelp will hit 39 compared to 38. So in this case, they need to offer you a cheaper price. So take a look at the $37 strike price. That's trading for $1.15. That contract, it's more expensive because it's not that far-fetched that Yelp will go from 36 to 37 within the next 30 days. Now, I want to teach you about the duration of the options contract. So if you're thinking that this whole thing, everything that we're talking about, if you think that it sounds risky because, well, you don't know what's going to happen in the next 30 days with Yelp stock. If that's how you think, then I would say you're absolutely correct. I would agree with you because 30 days is not a lot of time. But what if I told you like Yelp is at $36, I'll give you the option to buy it at 38, but I'll give you that option for 7 months. So that scenario, it would be more appealing to you.
Okay. And people do that. And that can fit your strategy. The problem with what's that's going to happen is that the longer it goes out, the longer the time value is. The longer the time value is, the more expensive the contract is going to be, right? So there is a strategy that you can use with put options. When you're writing a put option, if you want to buy 100 shares of stock that you can use. And I'll get into that later, but just keep in mind, and if you understand that this much, is that the longer the contract, the more expensive it's going to be if you buy it, the more money you take in if you write it or sell it.
You because you have more time for Yelp to go up. However, those favorable conditions, they're taken into consideration. Therefore, if you want more time on your contract, then you're going to pay for it. So take a look for yourself. I circled at the top your ability to choose the expiration dates of the contract. So we're using the same strike price at 38. For a contract that expires in 7 months, this contract is going to cost you $3.90. So compare that to the contract that expires in 30 days that's going for 80 cents. If the expiration date of the contract is sooner, then the contract will be cheaper. If the expiration date is farther out, then the contract will be more expensive. Now, I must clarify this one last thing because it's very important. Options contracts are for 100 shares. So if you buy one options contract of Yelp at a $38 strike price, then you're buying the option to buy 100 shares of Yelp at $38. And the contract price, it's quoted at 80 cents, right? So that's 80 cents a share. But you have to remember that you're dealing with 100 share increments. So if the options contract says 80 cents, then the options contract will cost you $80. So if you buy 5 options contracts, it's going to cost you $400. Now, I hope that this has helped you to better understand call options. Now, in this next segment, we're going to proceed to covered calls. So covered calls,
So a covered call is this, right? And there's a real good strategy. So listen. Okay, so here's what I think the scenario he's about to talk about, right? So you get different color tool here. Boom. Boom. All right, so here's what I think he's about to talk about. So let's say you bought Yelp years ago, right? In this scenario, I said you bought Yelp 2 years ago, right? Boom. At $20, right? Now, to make sure it's a covered call, one contract would equal 100 shares. I have 100 shares right here, which is called lot, right? A lot. So I bought it at 20. It's been moving up over the past 2 years. It's at 38. Now I'm thinking, I want it to go up to 58. If it's willing to go up to 58, I'll probably sell, right? So what I'm going to do is I am going to write a contract, right? Write a contract. And you'll have a option to do this on your brokerage firm. I'm going to write it, and instead of getting the money from 20 to 58, I'm going to make a little bit of extra money, right? So I won't just make 58. Let's say the contract is worth 3, right? So at 3, I won't make $38. I will make, simple math, right? 41. So I'm making a little bit more marginally. Now, I'm willing to sell it at 58 already. I have 100 shares. So why wouldn't I sell a contract? Why wouldn't I sell a call option? The only reason that you wouldn't be able to do it is you might lose out on future profits if it goes above 58. Other than that, that's it.
Still going to be dealing with call options, but we're going to be taking it one step further. And this will help you to decrease your risk and generate passive income. So I'm going to explain to you why stock market investors love covered calls, and then I'm going to show you how to do it. If you think that covered calls are complicated, they're not. I'm going to break it down for you nice and easy, and then you're going to become a much better investor in the stock market. And I just want to say that personally, I'm a big fan of covered calls because it gives me a steady stream of income. Now, let me tell you the good and the bad of covered calls. So the good...
Now again, I can't stress this enough. That's if you have 100 shares. If you have 100 shares, you sell one contract. If you have 200 shares and you want to get out of your position, you sell 2 contracts, right? That's it. But if you have 50 shares and you sell one contract, you could be asking for trouble, right?
Good thing about a covered call is that you will be paid income. Now, this could be weekly income, it could be monthly income, annual income. It's your choice. You get to decide. You make money.
And the income is based on the expiration. It's I don't like how that's worded. The income is really based on how long the contract is. So if the contract expires in a week, yeah, you can make weekly income, right? But you're just selling the contract for how long the term is, right? So
by selling the call option. So I want to be very clear about this. In this scenario, you cannot lose money by selling the call option. So you could lose money on your stock.
So since he's a CPA, he doesn't have to say it. But if I was to explain this to clients, I would have to say, I'm regulated to say that you could potentially lose out on future value.
Stock, but you cannot lose money on the sale of the call option. It is guaranteed money. Even if you're a beginner, you will make money by selling the call option. But there's a trade-off. The bad thing is, when you sell the call option, you are limiting your upside potential if your stock goes up.
God bless you, sir.
So don't worry, I'm going to draw this out for you. I'm going to be very clear about this. I'm going to show you the math. Now, I want to clarify this for you. In the previous examples, we were dealing with call options and you are the buyer. We're still going to be dealing with call options, but in these examples, you will be the seller. There are 3 scenarios where you sell call options. Scenario number 1, you buy a call option and then you sell it. Scenario number 2, you sell a call option. And scenario number 3, you buy a stock and then you sell the call option. This is a covered call. So let me explain to you a covered call and how you make guaranteed income. And we're going to use a real life example, a real stock, the real price, the real call option prices. I thought that this would be best because I want to show you that this entire conversation is legit. We're going to be dealing with Intel stock, ticker symbol INTC. At the time of making this video, Intel is at $32 a share, a little bit over, but we'll call it 32 to make it easy. And we're going to use the Intel call option that expires in about 2 months. And that call option with a $34 strike price is selling for $1.50. So again, what I'm showing you is a real life example. So these are actual numbers. Keep that in mind. That's important because you're going to see how much money you can make and it gets kind of wild. Okay, so here's the situation. Let's say that you buy Intel at 32 and I give you an offer. So I, Brian, want the option to buy Intel from you at $34 within the next 2 months. So if you're going to give me that option, then you're not going to give me that option for free. So you're going to tell me, okay, Brian, if you want that option, then it's going to cost you $1.50. And I tell you that, okay, you got yourself a deal. Let's do it. So I pay you $1.50 to have that option to buy Intel from you at $34 within the next 2 months. So in other words, you sold me a $34 call option that expires in 2 months for $1.50. Okay, so why would I do this? Why would you do this? Let's work out 4 scenarios and I'll show you the math. So scenario number 1, the share price of Intel goes down. So you bought Intel at $32 a share. And let's say that in 2 months, Intel falls in price by $2. It goes from $32 to $30. So in this scenario, I'm not going to use the call option that you sold me because why would I buy Intel from you at 34 when I could just buy it on the open market for 30? So in this scenario, you sold me a contract that turned out to be worthless for me. Okay, so for you, Intel falls from 32 to 30. You lose $2 on the stock, right? But you made $1.50 by selling me the call option. So you hedged and you're only down 50 cents instead of $2.
But just so you know, this strategy is just a very limited strategy, right? So if you just bought it, right? If I forgot what he said, what it was. If you just bought it at 32, right? If you bought it at 32 and you are selling if you're selling call options, then you really should expect the market just to be real flat, right? Which is called consolidation, right? You want it to be flat. Usually when people start selling covered calls, they've been in it for a while and they're looking for exit strategy. That's the best way to do it.
So it's a good thing that, well, in this scenario, that you sold me the call option. Moving on to scenario number 2, the share price of Intel does nothing. So you bought Intel at 32. After 2 months, it's the same. Nothing happened. It's still at 32. In this scenario, you didn't make money. You didn't lose money on the stock. The price stayed the same. But you sold me the call option to buy Intel from you at 34. And I paid you $1.50 to have that option. But I'm not going to exercise that option because I'm not going to buy Intel from you at 34 because I could just buy it on the open market for 32. So in this scenario, congratulations to you. Your stock did nothing and you made $1.50. And let me tell you, making $1.50 in this type of transaction in 2 months is not bad because $1.50 divided by 32, which is what you paid for Intel, that's a gain of 4.6%. So you made a gain of 4.6% in 2 months. So if you annualize that, that's a rate of return of 28%. And again, these are real numbers. So this is how awesome options are. And the results get even better in the next scenario. So I'm going to show you. Scenario number 3, Intel goes up by a little. So you bought Intel at 32. Let's say that Intel goes up from 32 to 33. In this scenario, you made money on the stock because Intel went up from 32 to 33. Additionally, you sold me the call option to buy Intel from you at 34.
And that's the idyllic scenario. The most idyllic scenario goes up to 33.99, right? Or 34 on the dot. If it's 34 on the dot, it still won't be automatically exercised.
But the share price of Intel is at 33, so I'm not going to exercise my option because even though the stock price went up, I would rather buy Intel in the open market for 33 rather than buy it from you for 34. So this is an awesome scenario for you because you made $1.50 by selling me the call option and your stock went up by $1. So you're up $2.50 in 2 months. That's a 7.8% gain in 2 months. Annualized, that's a rate of return of 46.8%. Scenario number 4, the price of Intel shoots up. So you bought Intel at 32. Intel shoots up, let's just say from 32 to 40. So you have to remember that you sold me the option to buy Intel from you at 34 within the next 2 months, and it shot up to 40. So you know what I'm gonna do? You know what I'm gonna do with the call option that you sold me? I'm going to use it. I'm going to exercise it. I'm going to buy Intel from you at 34, and I'm going to sell it on the open market for 40.
In this scenario, everybody makes money. It's just the writer of the contract makes a little less, right?
So even though the price of Intel shot up to 40, you are forced to sell it to me for 34. So that was the contract. That was the deal. I paid you $1.50 for that option. So you bought Intel at 32. You sell it to me for 34. So you make $2 of gain on the stock. And I paid you $1.50 to buy that call option from you. So you make $1.50 there. You walk away with a gain of $3.50 in total. That's an 11% gain in 2 months. Annualized, that's a rate of return of 66%. That's pretty awesome. Now, with that being said, I want to ask you a question, and just think about this honestly. Would you be upset if this happened to you? Because you made an 11% gain in 2 months, but if you never sold the call option, then your stock would have went up from 32 to 40, and you would have an $8 gain on the stock. But you did a covered call, and you made a total gain of $3.50. So you sold yourself short. You still made money, but you would have made more money if you never sold me the call option. But of course, you didn't expect the share price to go up so high so quickly. So I guess it's just a matter of your point of view, whether you'd be kicking yourself or not over the situation. But that is the risk of writing a covered call. Again, you cannot lose money by selling the call option. The downside is that you are limiting your upside potential. Okay, so I hope that...
Okay. So just to be clear, you said you cannot lose money on selling the call option, right? And you can kind of hedge your position of the stock you own. But if your stock plummets, you can still lose money in the whole picture of things, right? Just want to be clear on that.
You're still following along. I hope that this is all clicking. But I have to show you 2 very important variables with covered calls: the strike price and the duration. But first, if you're finding this helpful, please give this video a thumbs up. I'm just trying to be helpful. If you can help me with the like, I'd appreciate it so much. And thank you very much. I appreciate it. Now, let's modify the variables and see how the numbers work out. Let's change the duration of the contract, which is the expiration dates of the call option. So the $34 call option 2 months out is selling for $1.50. But what if we changed the duration to 6 months out? Now, I want you to know this.
Baby, you're going to make some money. I recently looked at doing this for NVIDIA, and I wasn't selling a covered call, but I was writing a put, right? And listen, I'm not recommending anybody do this. This is just what I was doing, right? So I wanted to get in 30% lower than what the share of NVIDIA was, right? I was willing to buy 100 shares. So I wrote a a naked, not covered, a naked put. Because if I knew that if the stock went down 30%, then I was going to buy it. Now, here is the nightmare scenario, right? Is that I get it for 30% lower. Okay, let's say there's a big old nasty market correction. I get it for 30% lower. I also made money in writing the contract. But unfortunately, the contract still has some time value to the person I wrote it to. China invades Taiwan. The stock goes to zero. I'm losing my butt on that one, right? But if it goes down 30%, I'm happy to get into that position. If it goes down more than that, I'm kind of sweating a little bit, right? So that's the strategy right there. But what he's about to talk about is the longer the contract, the more the contract's worth. It's kind of like if you are buying car insurance, right? Once you renew your car insurance, that contract that you have is worth the most the day one. On your last day of your car insurance, it's worth least to you, right? Of course, if we're talking about insurance in that scenario, we'd be talking about puts, not calls.
The more time the call option has, the more expensive the call option will be. And that means that you as the seller would collect more money. So let's look at the call options on Intel 6 months out instead of 2 months. And here are the prices for the call options 6 months out. As you can see, the $34 call option 6 months out is selling for $2.61. So if you sell that call option, then you would receive $2.61. But here's the thing, you may be thinking, okay, but you can sell the $34 call option 2 months out and make $1.50. So over the next 6 months, why not just sell the $34 call option for $1.50 every 2 months? That way, you'll make $1.50, $1.50, $1.50, and then after 6 months, you'll end up with $4.50. So that sounds better than selling a single call option 6 months out and making $2.61, right? So that would be true if 2 months from now, the $34 call option were still selling for the same price at $1.50. And then 2 months after that, if the call option was still selling for $1.50. So in that scenario, yes, you would make more money by selling a 2-month option and then another 2-month option and then another 2-month option instead of selling a 6-month option. However, the price of the call option is...
And I've used that strategy before too. If you're looking to get out of the stock, I don't know, you could use both. Honestly, you could go month by month. I wrote a call one time. This was for a bank stock, and it was just getting higher and higher and higher. And every month it would get higher, I would up the strike price, right? And eventually it shot above, and the contract was exercised. And I was happy. I made good profit.
It's constantly changing. If the stock price of Intel falls from 32 to 28, the $34 call option 2 months out would probably sell for around 50 cents or even less. So that's the risk that you're taking by going with a shorter call option. If you lock yourself into a longer call option, then you know how much you're going to make in 6 months. If you go with shorter time frames, then you don't know how much that $34 call option will be selling for when the time comes. You may get a better price, you may get a worse price, so that's the risk. Now, let's change another variable. Let's change the strike price. So you can sell the $34 call option 2 months out and make $1.50. Or we can change the strike price to 38 and sell that option for 50 cents. If you go with a higher strike price, then you're giving yourself more upside potential to make money on the stock in the event that your stock goes up. So just think about it. You're guaranteed 50 cents in 2 months' time. If Intel shoots up to 38, sure, you're going to make less money by selling the call option because you're only going to make 50 cents instead of $1.50. But you're going to make more money from the stock going up. Because if Intel shoots up to 38, you're going to be forced to sell Intel at $38. But if you sold the $34 call option, then you would be forced to sell Intel at $34. But you probably realize the downside. If you bought Intel at 32 and it did a whole bunch of nothing, let's just say that after 2 months, it stayed at 32. Well, if you sold the $34 call option, then you could have made $1.50. Instead, if you sell the $38 call option, then you're only going to make 50 cents. So that's the dilemma. So for the call option, the closer the strike price is to the current price, the more expensive the call option becomes. The farther the strike price, the cheaper it becomes. Okay, now let me show you how to write a covered call. In order to write a covered call, you need to buy the stock first and then sell the call option. So do not buy a crappy stock because you don't want to make money by selling the call options but lose money on the stock. So that's like dropping quarters to pick up pennies. So find a good stock that you think will go up. And if you remember, with options, you're dealing with 100 share increments. So in this Intel example, in order to do a covered call, you need to buy 100 shares of Intel first, and then you sell the call option. So let's just say that you already own 100 shares of Intel. In this scenario, you would just place a single order. Sell to open, one contract, select the expiration date and the strike price, the price of the option, and that's it. Piece of cake. Very easy. If you have 500 shares of Intel and you want to write covered calls on all 500 shares, then it's going to look like this. Sell 5 call options. And just so you know, you don't have to write covered calls on all your stock. If you have 500 shares of Intel, you can write 1 contract, you can write 3 contracts, whatever you want. And you're going to notice that it says $750. That's how much money that you're going to make from selling 5 covered calls. So here's the math. The $34 call option is selling for $1.50. So that's $1.50 a share.
But again, if you write 5 contracts, you need 500 shares in order for it to be covered. If you don't do that, it's called naked, and you could lose your shirt, right? So stock could potentially go to infinity, right? And if it's not covered, then you owe infinity, right? So you got to be careful. You can write naked calls, but you have to have some real bearish sentiment to kind of back that thinking up. And I'm not saying don't do it. I'm not saying do it. I'm just saying that it carries a lot of risk.
Share. Multiply that by 100 shares, and that's $150 for each call option contract. Multiply that by 5 call options that you're selling, and you make $750. $150 a contract times 5 contracts equals $750. So as I said to you before, you need to buy the stock first and then sell the call option. But I want you to know that many brokerage accounts will allow you to buy the stock and sell the call option at the same time. So it'll be...
And that's what's called married. And there is the strategy for doing that is so you can pay long-term cap gains and not short-term cap gains, right? If the contract is over 12 months.
Simultaneous. So it would look like this. You're completing 2 actions at the same time. Buy the stock, sell the option. Now, let me finish by telling you what happens after you write the covered call. As soon as you sell the call option, you receive that money immediately. So if you sold the $34 call option 2 months out for $1.50, which would equate to $150, then you would receive that $150 in your account immediately. So it's automatic. It's going to appear in your account. It's going to appear there like magic. So you don't have to do anything. Now, after 2 months, let's say that the price of Intel ends up at 35, which is above your $34 strike price. Then you would be forced to sell your Intel stock at 34. And your Intel shares would be sold automatically. You don't have to do anything, they take care of it for you. If the price of Intel ends up below 34, then the call option that you sold expires worthless and it's automatically eliminated. So you don't need to do anything. Your brokerage account takes care of everything for you. And you have to remember that you got paid upfront for selling the call option. Now, I want to give you these last tips. The premium is a fancy way to say the price of the options contract. So if the $34 call option is selling for $1.50, then $1.50 would be the premium. If you're selling the option, the more premium, the better, because as the seller, you want to get paid more money for writing the contract. In terms of how...
And a good way to get a higher premium is you can check the trading volume. If there's a lot of volatility on the stock, you're going to get a higher premium.
Options are priced, I want to explain this to you in a nutshell. More time on the contract means more premium. The closer to the strike price means more premium. The more volatile a stock is means more premium.
And if it looks like I'm bored, I can do this stuff in my sleep a little bit. So, if it's new to you, this is great. This is a great video. I recommend this video. Not just because moi is on it, just because it's done pretty well. They leave a little stuff out. They leave some stuff out like spreads and straddles. So a spread is when, let's say you and I kind of covered this earlier, and you can do this for calls and puts. You buy a, there's 4 different types of spreads, right? Oh, there's actually more than that, but we'll just do one of the 4 main types, right? You buy a call option, right? You only expect it to go this much up, right? So to reduce the premium you pay here, you write one over here, and you make sure, unless you're trying to do what's called a calendar spread, you make sure that they have the same expiration, right? And you could do that with puts too.
So regarding volatility, this makes sense because just think about it. If a stock is going up or down like crazy, then you deserve to be compensated more for locking yourself into a contract at a certain price. Because who knows what's going to happen to the stock within your duration. So when you're looking to write covered calls, make sure that the deal makes sense. Because you have to remember, the downside is that you're limiting your upside potential during the contract's duration. So if the risk is not worth the reward, then don't do it. I know that the appeal of guaranteed income is great, but if it's not worth it, just don't do it. Use your best judgment. I trust you.
And the reason why he's covering, I believe, he's covering the covered call strategy is because it's a very low risk strategy compared to a lot of the other options things you can do, right? Especially if you've been in the stock for a long period of time and you plan on selling it, it's great. The problem with, options were originally made for like insurance and liquidity, and a lot of people use them like casinos, right? So you don't want to do that unless you're one of those people that like losing money, which I guess gamblers actually, that's the rush they get out of it. But yeah, I didn't know that either till someone told me that recently. But yeah, don't use it like a casino. Use it as a tool like it's supposed to be used.
If you want to find good covered calls, it's like shopping. You have to shop around for good deals. Sometimes there won't be any good deals. Other times there will be a lot of good deals. So usually there are a lot of good deals on a lot of good stocks. Just use your best judgments and you'll get the hang of it. I hope that this has been helpful, and I want to tell you this. If you need to rewatch certain parts, please do so, because that is normal and that is expected. I'm just happy that you're taking the time to improve yourself and learn this to become a better investor, because this is going to be a game changer and it's going to give you more opportunities to make more money.
And he absolutely is right. It is a game changer. You got 100 shares. Why not write a call option, right? It might not be suitable for everybody, but it's not a bad strategy.
We are now moving on to put options.
Okay, so put options. Remember that car insurance scenario I said? So imagine a put option is that, right? If you're buying a put option, it's like buying car insurance, right? You expect the car to go down in value if something happens. So the time that you buy your car insurance policy has the most value. When it gets to close to expiration, it has the least value, especially if nothing's happened, right? So if you understand that much, you're good.
Then put options will be you can think of it as the complete opposite of call options, but I'm going to break this down for you nice and easy. I will explain to you what are put options, how you can make a lot of money with put options, and how you can lose a lot of money with put options as well. So let's start from...
And listen, if you're writing a put option, just mathematically speaking, you're going to lose less money than you would if you were writing a call option. Just mathematically theorizing. I don't even know if I'm going to include that part in the video, just because people will be like, well, you said it's only because the lowest stock can go down to zero, right? But a stock can go up to an infinite level, right? So if you have a stock worth $10 and it goes to zero, well, you lost 10 points, right? Minus the premium that you wrote it for. However, if you write a call option and it's at $10 and it goes up to 100, well, you can see how the math is mathing there.
Scratch. What is a put option? A put option is a contract between a buyer and a seller. So let's pretend that I'm the seller and you are the buyer. So in other words, I am selling the put option and you are buying the put option. Now let's choose a stock. Dave & Buster's stock, ticker symbol is PLAY, play. Dave & Buster's is currently trading at $44.96, but to make it easier, let's just say it's $45 a share. And I want to make a deal with you. What if I told you within the next month, I will give you the option to sell Dave & Buster's stock to me for $40 and I'll buy it from you. So you don't have to sell it to me, but you can if you want to. That is your option. But I'm not going to give you that option for free. If you want that option, you'll have to pay me 45 cents. And let's just say that you agree, you'll pay me 45 cents to have that option. So ultimately, you bought the Dave & Buster's $40 put option with a 1-month expiry for 45 cents. So it sounds fancy, but it's very straightforward. But you have to remember that right now, Dave & Buster's is at $45 a share.
And here's another thing, right? Let's say you bought Dave & Buster's at $30 a share. Dave & Buster's just had some great news. But you know that there's a court case potentially coming down the pipeline, right? You can keep your Dave & Buster's shares, but you could also buy a put option to cover your losses, right? And that will give you that extra net of safety. So it's at 45, you expect it to go down to, let's say, like below 40. You would get your strike price as close to the share that you have now, the 100 shares that you have now. So you would get your strike price at 45.
So you're not going to go buy it for 45 and then sell it to me for 40, because if you did that, then you would lose money. You would lose $5 a share, so you wouldn't do that. So the question is, how do you make money? So you want Dave & Buster's stock to crash within the next month. If Dave & Buster's stock falls to, let's just say, $30 a share, then you would be so happy. Because if Dave & Buster's falls to $30 a share, then you can buy Dave & Buster's on the open market for $30, and then you could immediately sell it to me for 40.
And listen, that's kind of what Mark Cuban did when he got his Yahoo stock. He sold some software to Yahoo. Yahoo paid him in stock, and he bought a put option for insurance. And then Yahoo tanked, and he exercised those options, man. And he's a multi-billionaire now.
And then you would make a gain of $10 a share. And you have to remember that you paid 45 cents to have this option. Therefore, your true profit would be $9.55. So that would be an awesome rate of return because with 45 cents, you made $9.55. And I want you to know that this is a real life example. Those are real numbers. Take a look for yourself. This is the options chain for Dave & Buster's, ticker symbol PLAY. We go about 1 month out, we open that up, and you get this. So don't be intimidated. This is very easy to read. So we're looking at the $40 put option that's selling for 45 cents. You refer to the ask at 45 cents because if you're trying to buy the put option, the seller is asking for 45 cents. So you look at the ask. Now let me give you a different example to show you how you lose money. So let's just say that you bought the same put option. You bought the $40 put option.
Simply put, he's going to say this. You bought a put option, the stock goes up, your contract's worth nothing.
Expiring in 1 month. If Dave & Buster's does not fall below $40 in a month, then your contract will be worthless. So to demonstrate, Dave & Buster's is at $45 a share. Let's just say that the stock falls to 41. Then in this situation, your contract would be worthless. Because why would you exercise your option to sell it to me for 40 when you can sell it on the open market for 41? So if the stock does not fall below your strike price before the expiration, then you wasted your money on buying the put option. So in this example, you paid 45 cents for nothing and wasted your money. Now, I need to tell you about the duration of the contract, and I'll teach it to you like this. I'm going to give you 2 offers, and you tell me which one sounds better to you. Offer number 1. You can sell Dave & Buster's stock to me at $40 within the next month. Offer number 2. You can sell Dave & Buster's stock to me at $40 within the next 5 months. So you tell me which offer sounds better to you. And it's going to be offer number 2. Offer number 2 sounds better because you have more time for Dave & Buster's stock to fall below 40. However, this favorable condition, it's taken into consideration, and I'll show you. So take a look for yourself. Here are the options contracts on Dave & Buster's. For the put option 1 month out, the $40 put option is selling for 45 cents. Now, I want to show you the same $40 put option, but 5 months out. So we open that up and we see this. The same $40 put option is selling for $2.40, which is a big difference compared to 45 cents. So regarding the duration, the more time on the contract, the more valuable the contract is, so the more expensive it is, time equals money. So you can check the same $40 put option that expires in a week, and you're going to see that the contract will be cheaper. You can check the same $40 put option that expires a year and a half from now, and that will be much more expensive. Now, I want to tell you about the strike price. I'm going to give you 2 offers again, and you tell me which one sounds better to you. Offer number 1. Within the next month, you can sell me your Dave & Buster's stock for 40. Offer number 2. Within the next month, you can sell me your Dave & Buster's stock for 45. So which offer sounds better to you? So in this situation, of course, offer number 2 is going to be better for you because you would rather have the option to sell me Dave & Buster's stock at a higher price. However, this is also taken into consideration, so take a look for yourself. This is the put option 1 month out. The $40 put option is selling.
And guys, I just want to say this. If this sounds complicated, it is at first. It is at first. But if you could tell where I'm at right now, I'm almost nodding off because I've done this stuff so many times. And even though I do it, when I do it, when I write or do an options contract, I still call my brokerage just to double check my work. But I understand the mechanics of this so well that it just, like, once you get skilled in it and you practice at it, and it's not like riding a bike, you gotta kind of practice and kind of learn it. But at this point, man, I'm almost falling asleep. And if this was new to me, I'd be like this. But it becomes the point I'm trying to make is that don't be discouraged. At first, it's a little bit of a head scratcher, but once you get the hang of it, it's so simple. It's elementary.
Selling for 45 cents. The $45 put option is selling for $1.90. The higher the strike price, the more valuable the put option is. So compare that to the $35 put option, which is selling for 15 cents. Therefore, a higher strike price is more expensive and a lower strike price is less expensive. Now, I want to remind you that with options, you're dealing with 100 share increments. So if you buy the Dave & Buster's $40 put option for 45 cents, then you are buying the option to sell 100 shares of Dave & Buster's at $40 a share. And that put option will cost you $45 because that put option costs 45 cents a share multiplied by 100 shares equals $45. So if you want to buy the Dave & Buster's $40 put option expiring 1 month out for 45 cents, this is how you do it. The stock symbol for Dave & Buster's is PLAY. Buy to open because you're buying a put. You're buying one contract. You choose the expiration date.
And I'll say this: every platform looks different. He's on Robinhood. I've been on E-Trade and Fidelity. They just look different than this, just simply put, right? But they, especially E-Trade, they'll give you a bunch of different kind of options of what you want to do, right?
You choose the strike price and you're buying a put. The price of the contract is 45 cents. But remember, you're dealing with 100 share increments, so it costs $45 to buy the put option. Now, if you want to buy 10 put options, you would just change the number of contracts to 10. And that would come out to $450 in total. That's because each contract costs $45 and you're buying 10 of them. Last thing I want to tell you is this. Let's say that you buy the Dave & Buster's $40 put option and the stock falls to 30. You don't
Hallelujah.
Literally have to go out and buy 100 shares at 30 and then use your put option to sell your 100 shares at 40. You can just sell the put option itself as if you were selling a stock. And this is what it would look like. Sell to close. If Dave & Buster's falls to 30 a share, the $40 put option would trade for around $10. So you would type in the price that you want for the put option, no different than selling a stock, and you would make $1,000 per put option. That's because you make $10 a share multiplied by 100 shares, which equals $1,000. And remember, you bought the put option for 45 cents. So the put option cost you $45. And now you can sell it for $1,000. So you probably realize two things. Number one, if things work out well, then you can make a lot of money. But number two, if the stock price doesn't cooperate with you in your given time, then you lose. Now, this is very important. What I showed you is the most basic way to utilize a put option. But this is not the only purpose of a put option. Now, in our next segment, I'm going to show you how to use put options to decrease your risk and generate passive income. So you can do this with cash secured puts. Let's say there's a stock at $10 a share and you think that it's a good buy at 10. But you can create a situation where you can buy that stock for 9. And if it turns out that you can't buy it for 9, then you will get paid some money. So essentially with a cash secured put, you can buy the stock at a discount. And if you can't, then you're going to walk away with some money. Now, if you think that sounds too good to be true, it's not. I'm going to show you the good and the bad with cash secured puts. So personally, I believe that the pros outweigh the cons, but I'm going to
And here's another thing too. If you have a short position, you could always cover that short position with a put as well. Just so you know, it's called it's called a covered put, right?
I'm going to show you both sides of the story and you can be the judge. So we're using a real life example. Let's use ticker symbol.
And if you're also shorting a stock, you could also buy a call, and that limits your risk as well, right? Because if it shoots up, and I think I said this earlier, you're covered by the call. And that's if the amounts of shares you have match the amounts of shares in the contract, right?
SIRI, which is Sirius, the satellite radio company. So Sirius is currently at $4.89 a share. And let's say that you think that it's a good buy at $4.89 a share. So you can buy the stock at $4.89 and just hope that it goes up. So that's one way to make money. But another option is that you can do a cash secured put. So here's what happens. Essentially, you sell a put option. By doing so, you lock yourself into an agreement as follows. Sirius is at $4.89 a share. Within 1 month, if Sirius falls to $4.50 or below, you will buy Sirius for $4.50. And it doesn't matter if Sirius goes to $4.50, $4.49, $4, or $3. If Sirius falls to $4.50 or below, you will buy Sirius for $4.50. But within 1 month, if Sirius does not fall to $4.50 or below, then you will not buy it. However, regardless of which scenario occurs, you will be paid 32 cents for agreeing to this. Therefore, regardless of whether you end up buying Sirius for $4.50 or not, you will be compensated 32 cents. Now, I'm going to walk you through 3 scenarios, and you'll see how this plays out for you.
That's kind of what I was selling or telling you about earlier about with the NVIDIA. I was looking at options. I think they had a time value of about like 6 months, right? And I was going to sell sell a contract. It would have cost me, I think, about if I was to buy, right? I was selling a put option where I had the strike price. It would have cost me, I think, like $17,000, right? However, and don't quote me on this, I have to revisit it, but I think the money that I would make from the contract itself at that time was about $2,500. So you can see how this kind of makes sense in a buying strategy when you want to write a put, but you got to make sure that you have the money to buy the 100 shares, right? If you're going to buy it anyway.
And you'll see the pros and cons of a cash secured put, and keep in mind that these are real numbers, so you're going to see how much money that you can make. But first, let me show this to you so that you know that these examples are legit. These are real numbers. So we're using Sirius, SIRI, which is at $4.89 a share. Here's the options chain for Sirius. And we're going to use the options that are expiring in less than 1 month. It's in 22 days, but we'll just call it 1 month to keep it simple. And here are the prices on those 1 month options contracts. So take a look at the $4.50 put option. Those are selling for 32 cents. So keep this in mind that we're using real numbers in our examples. Scenario number 1, Sirius stock stays above $4.50. Now remember the deal. Sirius at $4.89. If Sirius falls to $4.50 or below in 1 month, then you are obligated to buy Sirius at $4.50. But if it doesn't go to $4.50 or below over the next month, then you will not buy Sirius. In this scenario, Sirius stays above $4.50. So Sirius could go up. It could go up from the current price of $4.89 to $6. Or Sirius could do nothing from $4.89 and stay at $4.89. Sirius could go down a little bit from $4.89 to $4.51. Regardless, In any of these events, the price remains above 450. Therefore, in this scenario, you do not end up buying Siri stock, but you still get paid 32 cents. So if you think about it, you did really well. Nothing happens. You didn't end up buying anything or doing anything, and you made 32 cents. But what was the risk here? The risk was...
And here's the thing. Like he said earlier, you want to do that for... You still want to do that for a winner, right? You don't want to do that for a loser, right? So for example, let's say, Sirius... Let's say Howard Stern leaves Sirius, right? It's going to go down, but where are they going to get that extra growth from, right? Kids these days aren't getting Sirius satellite radio. Radio's for a dying generation, right? It's more likely gonna tank than it goes up, right? So, and that's just a hypothetical scenario. That's just for educational purposes. That's not investment advice. But yeah, bottom line is you want to do that strategy that you just mentioned with a winner. Because if you get the stock, you get the stock, right?
That you could end up buying Siri for $4.50. And what was the reward? 32 cents. So if you make 32 cents by risking $4.50, that is a return on investment of 7.1% in 1 month. That is an annualized rate of return of 85%. And remember,
that's nice.
These are real numbers. Scenario number 2, Siri stock.
So if you've gained anything from this video this far, even if you don't understand the mechanics, I want you to let you know that if you buy 100 shares, buy a lot, it's called a lot, 100 shares is a lot. If you buy a lot of any stock, options are one of the best ways to increase your margins, not only for buying, but for selling, right? It's a great tool.
Stock falls to 450 or below. So let's say that after 1 month, Sirius falls to 440. In this situation, you are obligated to buy Siri for 450. And because you buy Siri for 450 and it's fallen to 440, you are down 10 cents. However, you have to remember that you were paid 32 cents to take on this deal. So in reality, you bought Siri for 450, but if you factor in the 32 cents that you were paid, then you really bought Siri for 418. And if the price of Siri is at 440, then you're actually at a profit of 22 cents. But I want you to put this into perspective, because remember, when you saw Siri at 489, you liked the stock and you thought that it was a good buy at 489. But by going with a cash secured put, you bought Siri for 418. So you got a much better deal on the stock. You got in at a 15% discount. And remember, we're dealing with real numbers. So this is why a lot of investors love cash secured puts, because they pick a stock that they want to buy and they get to buy the stock at a discount. And if not, then they're going to walk away with some.
So the thing I like about this is why I like this guy. And if you haven't subscribed to him, you should. He picked one of the 2 most safest strategies you can use, right? And God bless him, because a lot of people, again, use these things like casinos. And if you made it this far, you see one of the 2 easiest ways to do it. Just need a little money in your pocket in order to do it, but you can do it. They're pretty safe scenarios. If you want to get into a stock anyway and you want to buy 100 shares, why not use that strategy, right?
Money. So it's a win-win situation. But I want to tell you the danger of a cash secured put. I want to show you the nightmare scenario. So here's scenario.
It could go down to 0, right? That's it. But if you were going to buy it anyway, so what, right? Well, you were going to lose your money anyway.
Number 3, Siri stock plummets. So Siri's at 489. And remember the deal. If Siri falls to 450 or below,
you are forced to buy it at 450. In 1 month, if Siri plummets to $1, you will be forced to buy Siri for 450. So yes, you did get paid 32 cents for making this deal. So your true purchase price is 418, but still the stock fell to $1. This means that you are down $3.18, which means that you're down 76%. So here's my recommendation. If you're thinking about doing a cash secured put, I would recommend doing it on a stock that you think is already a good buy. But you have to put things into perspective. So if you thought that Siri was a good buy at 489 and you bought it at 489, if it falls to $1, then you would be down 79%. If you do the cash secured put, then you would be down 76%. So even though this is a nightmare scenario with a cash secured put, it's not like you would have been spared or done any better if you bought this stock outright. But I want you to still be aware of the danger. Now let me show you how to execute a cash secured put.
Sorry.
So it doesn't matter which brokerage account that you're using, they'll all be similar. You go to trade options, and then you'll see an order screen that looks similar to this. In order to create a cash secured put, you will place a single order. And then you choose the ticker symbol of the associate cancel itself on.
The reason why I skipped with that is if you're going to do these things, call your brokerage before, unless you're in a real rush, but you should have this strategy planned before you do this anyway, right? Whether it's a covered call or a cash, what do you call it? A cash covered put. We have a different name for it, but just a covered put. You should know that you want to go into this anyway. It shouldn't be a knee-jerk reaction, right? Look, sometimes there's something that happens with the market. So, for example, I'll give you an example, right? Say there's a huge amount of it. Let's go back to 2008. There's a huge amount of volatility that the market just crashed, right? You want to use this strategy that he just said just now, right? You want to get into right where the market is. Even if it goes down 10% more, everything's at a bargain right now. People are screaming it's a bargain, but people are fearful out of their minds, right? The VIX just shot way up because of all the options trading. You sell, you write a covered put. You write a strike price higher than what the market is, so you're making like a lot of money, right? And you know you want to get in, and you know you have the money for whatever increments of 100 shares you want. You write it for higher than the market is, right? So you're going to make a pretty good amount of money. One, because there's a huge amount of volume, and two, because the strike price is higher than what the market is, right? So you're going to make money on that option. The downside of that is if the market goes down to zero, right? You'd be betting against the U.S. stock market, but the U.S. stock market had already gone down, right? So that would be the idyllic scenario if you wanted to get in right at that price, right? You would look for volume and you look for something that already went down. But that's what I would do personally. Again, there's risk involved with that. It might not be suitable for anybody, but that would be the idyllic scenario for me personally.
Automatically. You can switch this to good till canceled, but that's up to you. So I told you, it's very easy and straightforward to execute a cash secured put. In a separate video, we'll cover how to shop around for good deals on cash secured puts. So this is something that you'll get better at with experience. Now, I want to tell you this. If you made it this far, then I know for a fact that you are serious about becoming a better investor. So I encourage you to please check out our website. I'm going to leave a link for you down below. I'm always looking for good options. I'm always looking for good deals. So please stop by. Thank you so much. Please.
All right. Again, my man is Clear Value Tax. great video, great video, and I like the both of the covered options that he chose. He could have done a lot of different things. He could have went to spreads, and I like spreads too, but they're a little bit more complicated, right? So the two that they named was perfect. But yeah, Clear Value Tax. Give him a subscribe. Great guy.